Hi, Gabriel Josiah here. Today, we are diving into a key metric every finance professional should master. It's called the Trade Payables Period. It's also known as Days Payable Outstanding, or we shorten it by the acronym DPO. This powerful ratio reveals how effectively a company manages its cash flow and supplier relationships, directly impacting liquidity and financial strategy. Whether you are preparing for exams or applying this knowledge in real-world scenarios, understanding the days payable outstanding will give you an edge in driving sustainable financial practices. Let's dive in, and let me share my screen so I can show you graphically how this ratio is calculated and applied. Okay, you can see my screen now. This is our custom. The days payable outstanding, or the trades payable period, measures the average number of days a company takes to pay its suppliers for goods and services received, or you call it purchased, on credit. Companies purchase goods or services on credit to in turn sell to earn revenue with that. So most of the time, the credit purchases is what is used to track how much or how long the company can pay, or how fast, to foster relationship with the suppliers and also earn revenue through those purchases, turned goods or services to clients or customers of the business. Now, it's crucial for understanding a company's cash flow management, and this metric helps us with the way the company manages its relationship with suppliers. The formula is simple. It's stated as the average trade payables divided by credit purchases. And where you don't have credit purchases on the financial statements, you have the cost of goods sold as the alternative in calculating the ratio, expressed as 365 days, which is typically a year, or 366 days when it's a leap year. So it's clear you have it as average trade payables, which is your beginning and the ending, divided by 2. You express it as an average. If you have it as 3 years, you do that by 3 by picking the 3 trade payables divided by the credit purchases, like we said earlier, or the cost of goods. So let's use the example we've been using in buttressing or portraying these calculations like we've done in the previous ratios. Let's use the company Sharubutu Nigeria PLC to calculate this ratio graphically. Okay, so our average receivables, it's from our trade payables, we get that, which is in our current liability section of the SFP. So if you can see my screen clearly, you'll see that the trade payables from the beginning is 150 million, which is 1st January 2020, and for the ending 31st December 2020 also, we have it as 180 million for trade payables. Okay, so I'll pick that. If you have your calculator, just follow me closely. I'll be using Excel to calculate this, which is also plus and minus for us. Okay, so we have the trade payables beginning and ending. So I'll just pick this and have it here as our trade payables. So let me categorically state it here as the opening, and also state this here as the closing. Okay, so let's get our total trade payables. Have that as the total of these two, total of the beginning and the closing. And we have it as 330 million naira. Now let's get the average. So our average trade payables is our total trade payables divided by 2. Our total trade payables, beg your pardon, let me express that again. So we have our 330 divided by 2, which is the average. we have it as 165 million on average for the year 2020. So let's go get our denominator, which is our credit purchases from the question. Okay, so our credit purchases is expressed from the SCI. We speak from the SCI. So the SCI we have from Statement of Comprehensive Income, purchases for 31st December 2020, which includes 1 billion naira. Purchases is 1 billion naira, as you can see on the screen. But take note, there is a caveat or a note, which is number 3 in the SCI, which states, okay, number 2, I beg your pardon, number 2 states of the total purchases yearly, you see that 70% was made in cash and 30% was made on credit. So it's clearly stated there. So of this 1 billion naira, 30% is cash and I beg your pardon, 70% was made in cash and 30% on credit. So we just express or get 30% of 1 billion naira, which is clearly stated or clearly calculated as 300 million naira. So let's go calculate that. So we have it here as our credit purchases. So let me expand the cell, and this is our total purchases. So to have the credit purchases, we have it. Okay, so let me take this to another cell, if that would enhance our understanding. So let's say this is our purchases, and our credit purchases would be 30%. So your cash purchases is 70% as stated in the financial statements. So we'll have this as the credit purchases times 0.30. It's the same as 30%. So we have it as 300 million credit purchases. So now let's have our trade payables period, which is our average trade payables divided by our credit purchases times 365 days based on our formula, and we have it as 200 days. So we have it as 200 days. So 200 days typically on average is what it takes for Sharobo 2 in the year 2020 Nigerian PLC to recoup or pay, sorry, not recoup, to pay for credit purchases, which is quite high, 200 days, which is quite high. Okay, so what does this mean? What does this mean? So let's go back to our discussion. So a trade payable period indicates how long a company takes on average to pay its suppliers. Of course, we looked at that. A longer payable period, like we saw, 200 days, suggests that the company is effectively managing its cash flow by delaying payments, while a shorter period may indicate a company is paying its suppliers promptly. So it's trying to manage cash flow by delaying payments, while a shorter period indicates the company is paying its suppliers promptly. Now, what is the implication? A longer trade payables period is generally favorable, as it allows a company to retain cash for a long time, thereby enhancing liquidity. However, excessive long periods may strain supplier relationship because you're also holding their own cash or their own funds, and may lead to potential penalties, especially where there are terms and your company breached the terms. It owes beyond a particular agreed period. That would activate penalty clauses in the SLAs, service level agreements, or terms of engagement. This is very important. Conversely, a shorter period may indicate strong relationship with suppliers or a focus on maintaining good credit terms. So meeting up the terms and paying as at when due, essentially based on agreement. And when it's a shorter period, it helps management maintain relationship with suppliers. Very important. So let's look at the cause and effect of a long or a shorter trade payables period. The cost of a long trade payables period generally entails effective cash flow management when the time to pay is longer and you've used the goods or services. You use your cash flow for other exigencies or important emergencies. Now, it also shows strong negotiating power with suppliers or delayed payment policies. So these are the causes of a longer or long trade payables period. The effects are increased liquidity for the company, better cash flow management, but there are risks also, which there's a potential risk of damaging your supplier relationship if payments exceed the credit terms given, and when you have excessive delays, it could damage the relationship and truncate the supply of raw materials or goods or services for your further production, also to service your customers or clients. Now, a shorter trade payables period, the cost is generally good supplier relationship. So we advocate for a shorter trade payables period, let's say 30 days, 45 days, 60 days at most, to meet your obligations as at when due. So 30, 45, or 60 days at most, based on the credit terms, is very important. So looking at the example of Shadow Bottle, you could see 200 days plus is quite a long time. Now, you will see that focusing on maintaining a strong credit rating is also a cause of a short trade period. So your creditworthiness is your focus and what is important for the company, especially to enhance relationship with your vendors or your creditors. Now, what are the effects of a shorter trade payables period? Improved supplier relation, you have a good relationship understanding, potential cost savings from short or early payment discounts, but may strain cash flow if payments are made too quickly. So management should try to strike a balance to ensure that there's a win-win situation. You don't pay on time, but you also don't pay late to meet your obligations as at when due. Okay, so in conclusion, the trade payables period is a key indicator of a company's cash flow management and supplier relationship dynamics. So being able to manage your cash flow, not paying quickly like we saw in the previous slide, and also paying as at when due to ensure that you don't strain your supplier's relationship, thereby cutting your supplies into your company. It's key. It's a management skill management has to master to ensure that this works seamlessly based on their operations and specific scenarios. By monitoring this ratio, businesses can balance the benefits of retaining cash for operations against the need to maintain healthy relationship with suppliers. This is very important. This ultimately enhances the financial stability and operational efficiency of the company. So maintaining a balance is very important. Balance of cash operations, delaying payments, and also meeting the needs of your creditors to sustain and maintain healthy relationship with suppliers enhances financial stability and operational efficiency. So this key management skill is essential to be able to understand operations and also make sure that everything works seamlessly in your day-to-day operational management. Okay, so to sum it up, mastering the trade payables period equips you to optimize cash flow while fostering productive supplier relationship. Critical for both exam success and real-life finance rules. Remember, days payable outstanding isn't just a number. It's a strategic tool to balance liquidity with supplier goodwill. This is very important. Goodwill, supplier goodwill is essential for you in the short and the long run. Okay, if this was helpful, don't forget to like, share, and subscribe for more insight into financial ratios and practical applications tailored for your exams and practical application in the office. Keep learning, keep excelling, and I will see you in the next video. Until then, bye for now.